through some of it, and then we're going to break up the afternoon by going into the FinLab at 2:15-ish or something like that. I'm going to start to attack lab exercise 1A, just so that make today a little bit easier for all of us. You know, it's a long day. Okay? It's actually not. It's actually a lab that's not due until Friday, but we can get started on it this afternoon. Okay? And again, next time we meet is Tuesday, right? Tuesday at 6 p.m. And try to be on time. Everybody knows to do that, right? Because there's a quiz right away. Okay? Okay. But as long as you guys are late, they're going to have a problem if they get there late on Tuesday. Okay, so let's talk a little bit. Chapter 3 is all about returns-based performance evaluation measures. So what does that mean? What is a returns-based performance evaluation measure? Quite simply, it's one that uses only returns information on a manager to assess their skill. Okay? So I say that because there are other ways also to assess a portfolio manager's skill. You can look at their holdings, their security holdings, and that'll be the topic of Chapter 4. Okay? Chapter 3 relies only on returns. Okay? Chapter 4 also uses holdings. We could also interview the manager to see what we find out about that manager's skills. Ask that manager, what do you know about economics? What do you know about covariance matrices? And give them a pop quiz or something like that if you wanted to. Okay? But why do we need to have these techniques for doing stuff if we have other approaches like holdings and can interview the manager? Why do we need Chapter 3? Sorry? Quantifiable, but the holdings are also quantifiable. I agree with you that interviewing the manager may not give you too much results in terms of maybe soft information. I agree with that, but why not holdings information? So why do we need Chapter 3? What are the cases when Chapter 3 can really help us is what I'm trying to ask. So think about what's available in the data and what data is available in the marketplace. What's the most widely available data that's available? Returns information, right? You can get that anywhere. And freely, too. You can get daily returns, you can get monthly returns, you can get yearly returns on most any fund. You know, so let's try. Fund of America. So I just do a Google search here. I can go to Bloomberg. I could go to Yahoo Finance. Right? I can get some summary statistics like the beta of the fund, the size of the fund. But I can also get historical data. I can download it, right? So this is very simple data to get. I mean, here I've got daily returns data, and I can get it. I don't know how far back I can get this, but you know, I think I could probably get monthly data a long ways back for this fund. So the answer to this is why do we need Chapter 3? Because in most cases, Chapter 3, the data that we have to work with is only the returns data. In many cases, all we have for a fund manager is returns data. Okay? Like I showed you, that's free data. Okay? By getting data on what the holdings, the portfolio holdings of the manager suffers from a couple different things. Okay? Okay, so let me ask you this. What is the difficulty in getting portfolio holdings data? What if I want to use portfolio holdings data to judge a portfolio manager's skill? Which I'll argue in Chapter 4 is a more precise way to arrive at the portfolio manager's skill. But we're in chapter 3 right now. Why might holdings data be difficult to get or to use? Just anybody throw something out. Yes, sir. Thank you. Thank you very much. You get a gold star today.
Does performance include those of private equity and others?
Anything. Just make it for anything.
If it's a private equity, then it might be more difficult to gauge holdings that are not publicly traded.
Not publicly available is the most obvious thing, right? Terrific. Thank you. Okay, so I don't know how to spell this thing. I guess it's like that. All right, so why can't I go to that private equity manager and say, can you please give me your portfolio holdings, Mr. Manager? Why can't I do that? No, I can say to the manager, can you please give me the information? I'm trying to do what I do. No, I'm not going to give you the information. Who are you? So you might be able to get this if you're a big investor. Most of the time, you can't even, get a hold of the portfolio manager or the company. They don't want to talk to you. Look, if you don't want to invest in our fund, you go somewhere else, okay? Take your money and go somewhere else. We don't want your questions. So they're not going to give it to you. Not publicly available for some types of funds at all. So I think it's useful to talk about types of funds. So we already have private equity. What other funds is it difficult, if not impossible, to get holdings data? What is in their portfolio? What's in their portfolio? What other types of funds? Is it impossible or nearly impossible to get holdings data for those funds? You as an investor. Come on, it's not that hard. What other types of funds are there? Hedge funds, thank you. Okay, gold star. Hedge funds, come on, this is not hard. Let's help each other out through this afternoon, okay? Help me. Private equity, hedge funds, what else? What did you say?
Mutual fund, pension, mutual fund.
Mutual funds, maybe, okay, but
But
there is some publicly available information. Let's talk about mutual funds for a second. Okay, mutual fund. Oh, and before we get to that, can you name a hedge fund that, or hedge fund manager who did not provide portfolio information, who ended up being a big Ponzi scheme? Who was the biggest Ponzi scheme of the last 20 years? Madoff, okay? So if people had had a precise reading of his portfolio assets, they would have realized he has no portfolio assets, right? So, anyway, that's beside the point. That's just a fun side fact. In my opinion, hedge funds should be forced to report their portfolio holdings every once in a while at least for that reason, for anti-fraud reasons, as well as to allow investors to understand the types of risks and so on. But unfortunately, that's not the case. They don't have to provide any disclosure to the public in the United States or elsewhere that I know of. Okay. Mutual funds, let's talk about them. Mutual funds do provide some disclosure. Sorry? So how much disclosure do they provide in the U.S.? How frequently do mutual funds have to report in the U.S.?
6
No?
6 months.
Once every 6 months? No. Not once a year? No, once every 6 months? No. It was once every 6 months 20 years ago.
Quarter.
Once every quarter? It's even beyond that now. It's once per month now.
1 per month.
Yep, so you're going all the way to once per month. Okay? In fact, you can go, so, US quarterly for, I think, 2016, I believe, monthly afterwards. And if you go into Morningstar, we could probably go into Morningstar Direct and look at this. You can probably get monthly data even before before the post 2016, because Morningstar seems to have been able to collect monthly holdings information for lots of mutual funds before they had to give it up. Okay, but still, we have to ask ourselves, so I guess this would say we have to ask ourselves, is this enough? I think if it's monthly, it's getting to be pretty close to enough to assess the performance of a fund manager without needing to use returns-based methods. So it's getting pretty close to being a great amount of information for US mutual funds. But certainly, it's not that way in Thailand, it's not that way in Japan, it's not that way in Europe. No other country has this level of disclosure frequency. So it's gonna be a lot harder to figure out, like it used to be in the US, how a portfolio manager is doing if you only get a snapshot once every quarter, or twice every year, or once every year. You have to do a lot of guesswork, okay, to figure out if their holdings are generating performance. So you really do need returns in these cases. So like, I would say, the vast majority of cases, you're gonna have to use Chapter 3 approaches, because this stuff is available pretty much for every type of fund out there, okay? Except that hedge funds don't have to provide this information. They only voluntarily provide returns-based information to hedge fund databases like TAS or HFR if they want to market to clients, potential clients. Otherwise, they do not have to report this to anybody except the regulator. Now, they have to report to the regulator over the last few years, but that's all proprietary and non-public information, okay? So the vast majority, so that aside, that some hedge funds you can't get any return information on, that aside, the vast majority of funds you can, at least in some private equity as well, they're not going to reveal their returns to anybody except somebody that they're trying to market to. And you could also add to this list pension funds. Fund managers who cater to pensions don't have to register with the SEC at all, because they are not offered to the public. They are offered only to pension fund sponsors, institutions, so they don't have to report at all to the SEC. So their holdings are generally not available, although you can get some of these, again, from Morningstar. And it's only because they voluntarily provide their holdings data to Morningstar. Okay, so all this complicated stuff I just went through, it's not that incredibly important to remember all that stuff. The bottom line, though, is that in a lot of these cases, if not most of these cases, returns-based performance measures are going to be extremely useful for reverse engineering what the portfolio manager is doing, and also figuring out if the portfolio manager has any skill left over after adjusting for these risk factors we just talked about in Chapter 1, at least for equity managers, okay? Okay, so that's what Chapter 3 is about, is how to maximize the amount of data that you can get using different techniques which are built on the research that's been done in academia over the past 30, 40, 50 years. What can we do? What kind of models can we throw at returns-based data to figure out reverse engineer what the manager is doing, and secondly, figure out if the manager has any skill or not. And that's what you're going to do in the lab the second half of this afternoon, is you're going to start to do that kind of stuff. That's going to be the whole objective of lab number 1 is to, number 1A, is to take sets of returns of several actual mutual funds and to reverse engineer using models what these guys were doing and whether they have any skill, okay? Very practical exercise for you. You go through kind of the same thing if you're trying to figure out what to invest in yourself, okay? So pay close attention to what's going on here to help yourself with Lab 1A, okay? Okay? All right. So I don't have to tell you that kind of the most important thing for an investor is investment returns, right? That's the main reason that you hire an investment manager. You want returns. So that's the output from the factory. So the factory is this less ambiguous office with a portfolio manager and with analysts. The input is your money, and their inputs are information and skills and efforts, and the output is, we hope, good returns, right? So you can think of this as a factory in some sense, and whether the factory is generating enough value added from the input, your dollars, and the fees that you pay to the output, which is the rate of return. And the rate of return is, of course, a distribution of returns, not a single one. We have to think about both the average return and the risk of the return. Okay, both. I have to think about if this differential between the two is value added enough to make it worthwhile. Okay, it's kind of like an NPV computation between the output and the input. Okay, the NPV is greater than 0. You like this manager, but you would actually like to find the manager who has the greatest NPV in some sense. That's kind of the way to think about this. Sort of like a factory, I guess. Okay? So the way I like to proceed in this chapter is to use some example fund managers to drive home how we can think of these performance measures. So I bring to the table 5 different portfolio managers, and let me introduce them a little bit more nicely to you through some pictures. So I've got pictures of all these guys. These are probably pretty old pictures, but our famous manager number 1 is Peter Lynch. How many people have heard of Peter Lynch? Okay, he's a really famous fund manager in the US, and maybe the most famous stock manager. I don't know, Warren Buffett, I don't know if you consider him a stock manager, but Peter Lynch is probably the most famous kind of general stock fund manager that ever existed. He only managed for 13 years and then he retired. And look at what he did. He grew his fund from 20 million to 14 billion, okay? Both on the basis of superior returns and on the basis of he did so well that he attracted tons and tons of money. So 1,000-fold he grew his fund over a 13-year period. His approach was U.S. equity, aggressive growth, and if you read either a wiki page on Peter Lynch or if you read some of his books, he supposedly used some very, very simple methods of choosing stocks. He said that he would, in One Up on Wall Street, his book, he said he would go to the grocery store with his wife and take a look at the products and take a look at what people were buying to decide on which stocks that he would pick and buy. Now, I'm not sure I believe that, but it's a nice story. But anyway, he was not a quant manager for sure. So he had some kind of great model in his head, but it was not a quant model. It was some way of figuring out which stocks were going to were underpriced and were going to improve, and which stocks were overpriced and he wanted to stay away from. He ran, of course, the Fidelity Magellan Fund. This is a mutual fund. And really, he made investing in mutual funds popular in the United States. He started this big fad, if you will, of investing in mutual funds. Okay? In the 80s and in the 90s especially, investing in mutual funds became a really popular thing in the United States. Largely or partly based on this guy's huge success story. Everybody was dreaming of gold, of wealth, because this guy had seemed to provide exactly that for his investors. Okay, and he retired at a good point too, because his fund did well all the way up until he retired. And he's never run money again, so that's good. Okay, second guy is a guy that I know who was an absolutely outstanding fund manager, but I'm not quite sure what's going on with my PowerPoint is not doing that well. This guy ran this Legg Mason Value Trust Fund, which ended up being a $10 billion fund by the time he was done. And the problem is that he didn't follow kind of the same path as Peter Lynch. He didn't retire. He managed money. He managed this Legg Mason Value Trust Fund from starting in 1984, and I think he retired from it in 2007, if I remember right. So that's, 23 years? That's a long time to run a mutual fund. And he did exceptionally well all the way up to his last couple of years, and then he did really, really very poorly. So he's an exceptional case. It's really strange to understand a manager who consistently did well. Everybody thought that he was the greatest fund manager who ever lived until he ran into hard times in 2005, 6, and 7. Okay, so it's an interesting thing too, to think about. His approach to investing was different from that of Peter Lynch. He followed a large cap value investing discipline, but he was different because he didn't care what value meant. And at times, value meant buying telecommunication stocks or technology stocks. He would buy those stocks if they were beaten down in price. He didn't care what the stock looked like. It was just if it was a good value. Okay? Again, did extremely well up until the last few days. In fact, one statistic that's breathtaking is that he beat the S&P 500 index with this fund every year for 15 years straight. So if you can imagine doing that, even if you're taking risks to do it, that's a phenomenal record, right? You can imagine how, what if you were flipping a coin? What are the odds that you can flip 15 heads in a row? I dare you to compute that. It's probably going to burn your calculator up, right? There's so many zeros to this, okay? But somehow he did this, okay? Not sure what's going to happen with my computer here. It's got problems with PowerPoint. Okay, all right, whatever. Okay, manager number 3 is a manager I also know. He had a different history to him. Scott Scholzel, he was a dot-com manager by and large. His heyday was during the late 1990s. That's when I was at the University of Colorado. So he came and he spoke to one of my classes or some of my classes one time. Toward the end of his really good run, he came and spoke in April of 2000. And if you know your history, in March of 2000, the NASDAQ peaked at its all-time high up until recently, okay? So he was just starting to get, on the downside of his dot-com era. But many people, again, thought this guy was one of the greatest managers who ever lived until he got crushed. But more on that later. His strategy was concentrated large cap growth. So much more than Bill Miller, much more than Peter Lynch, he believed in a small number of stocks and huge positions in a small number of stocks. In fact, there's a story that he loaded up so heavily on AOL, remember that crazy company, America Online? It used to be worth a lot of money in 1999. He had like $1 billion in AOL stock. He had like $1 billion in Time Warner stock. And in early 2000, one of the greatest mergers of all time, one of the most disastrous mergers of all time, AOL bought Time Warner, okay? He held positions in both, and the chairman of the two companies, Jerry Lavin and Steve Case, called him in a conference call, called this guy, and said, "Are you okay with this merger?" He held so much money in these stocks, okay? You don't normally get a call from Steve Case of AOL and the chairman of Time Warner, okay? This guy believed in really taking huge bets, and it really paid off for a long, long time. Fourth guy you could never know because he's an index fund manager. He's like the man who never existed, right? So nobody knows who, the poor index fund managers, they just work away and nobody pays any attention to them because everybody thinks they do nothing, okay? This guy, that's not true exactly, okay? They definitely do less, but this guy actually made a name for himself as a great index fund manager. So again, nobody still knows him except me. In fact, I one time was at a conference and I think I was supposed to introduce him or sit at sit on a panel with him, and I asked him who he was. I didn't know who he was, and I was kind of embarrassed myself because he's like the index fund manager of one of the largest index funds in history. But I suppose he gets that all the time. Okay, he's now retired and all that stuff. But he's our index guy. And then, of course, our bond guy is Bill Gross. You've probably heard of him. He had a big blow up a few years ago with PIMCO. So he's not with PIMCO anymore, but he was with PIMCO, and people consider him the greatest bond fund. Some still do consider him the greatest bond fund manager who ever lived, and so on and so forth. So we'll play around with him a little bit, but our focus is going to be on the 4 stock fund managers. Okay, the 3 active managers: Lynch, Miller, and Scholzel. The index fund manager, Sauter, And then we'll play around a little bit with the bond fund manager, but not as much. Okay? Okay? Okay, so now you've had a proper introduction to these faces. Let's go back to the chapter. I couldn't do the pictures in the chapter without having a problem with copyrights on the pictures, so I didn't do the pictures. I didn't know where to get a copyright free version of the picture, and why isn't that showing up? Okay. Might have to take a 3-minute break. I'm not getting any response. Let me try going back to this guy. Hold on, just 1 second. Let me shut this. Maybe. Okay, we'll take a 2-minute break here after you get technical assistance. Something's not working. Maybe I need to remove, I'm not sure. One of those days. Okay. Okay, let's go back to these guys now. Now that we've been introduced to them properly with their faces, let's, don't go away. I don't want Spotify. Thank you. I don't like Spotify. Okay. Okay, stay there, please. Okay. Okay, so here are our guys. Peter Lynch, all right, Fenelon Magellan, 1977, 1990, went from 22 million to 12 billion. Bill Miller, similar story, again, over a very long time period. Actually 30, I think I said 20 years, it's 30 years, okay, that he managed, until 2012. It wasn't 2007, it was 2012. He managed for 30 years, if you can imagine that, a portfolio. Scholzel managed for a relatively short 9 or 10 years, Sauter for just a very short amount of time, and Bill Gross for quite a long time as well. And so it's interesting for us to use these guys as test subjects for our returns-based performance analysis measures and models to see if they actually are skilled or not. Okay, so to set up the interesting question here, take a look at the manager 3 returns. So this is Scott Scholzel's returns, because he was manager of the Janus 20 fund. To remind you, Scott Scholzel was this guy. Okay, so let's go back. I hope it goes back. So his fund during 1998, take a look at the rate of return during 1998, 73.1, almost doubled the money of his fund investors, 73.4%. I think all of us would be very happy with a return like that in basically almost any year possible, even when the S&P is up 27%, right? We'd be enormously happy with this guy. But of course, we know finance, if you see a higher return, what does that usually mean? Higher risk, right? So we gotta figure out, how does this guy generate this type of return? Is it through true skills, or is he just taking some crazy risks, okay? And that's what a lot of performance metrics get to in this chapter. And there are a lot of ways you can figure out whether somebody is taking risks or actually generating alpha. You can repeat the experiment for many years, right? If he continues to perform like this over many years, then it's very unlikely, like the Bill Miller beat the S&P 500 every year for 15 years. It's very unlikely that somebody can do that from luck alone, okay? So that would be one way to do it, but we don't want to wait 15, 20, 25 years to see if a fund manager has skill. We want a fairly rapid resolution to this problem. And so the takeaway from this chapter is that the better your models are, the faster you can converge on whether a fund manager has a good probability of being skilled or not. The better the models, the better the model, okay, maybe models, because you need to use more than one usually. The better the models, the more quickly you can converge on whether a manager is good or not. And that's what we all want, right? I mean, in our personal life or investing, or if you are guiding somebody else as an advisor, you want to give them as quick of information as possible and not have to wait for 20 years, 25 years. They're probably going to give up on you if you wait 25 years, right? Okay. Okay, well, see, you can see this guy, did really well. And to kind of close out this story, he ended up having a really bad year 2 years later, 2.5 years later. From so shortly after he showed up to my class in April, in July of 2000 to July of 2001, this was the bursting of the dot-com bubble, his fund went down by 50%. Part of it was due to big losses on his dot-com stocks, part of it was due to money just fleeing out of his fund, okay? So it shows you, you really can't trust, you see this and you really can't trust those massive returns that he achieved at 73.4% in 1998. This seems to be purely a case of a lucky run on the dot-com bubble, okay? But I don't know for sure. It's not enough to just have the intuition of it could be this, it could be that. We need to quantify these things, okay, through good models, okay? This is just motivating our need to use good models. So figure 3.1 is the way that I'd like you to think about, here's a good way to think about the world of investment managers This is a good way to think about specifically the world of active investment managers, okay? This is a very simple, simplified, idealized view of the world. It's not accurate, okay? The world does not work like this. This is a simplified model of the world, okay? Just like my drawing of a car is not a perfect drawing of a car or something like that, but I think it's useful to look at this as a simplified way to think of the world of active management. So the simplification here is that there are only 3 types of fund managers. Now that's stupid, okay? There are thousands of types of fund managers. I just don't want to put that in my model because models are made to be simple, okay? I'm going to say that there are 3 types of fund managers. There's the unskilled managers who achieve a negative alpha or a negative t-statistic of alpha, okay, by some model, okay? I'm not even telling you which model I'm using for that, okay? There are fund managers called zero alpha fund managers. These are the fund managers that have 0 leftover alpha after adjusting for their risk factor exposure and adjusting for their fees that they charge. So they're no better than index funds in reality. And then there are these guys that we would love to identify called the skilled fund managers. We've got unskilled, 0 alpha, and skilled. We don't call these guys unskilled because these guys actually have enough skill to recover their fees, okay? Okay, so I think this is a useful way to think of the world. Problem is the world's a lot more complicated than this, and the problem is we don't know how many fund managers, even if this were the simplified view of the world, we don't know how many fund managers are here versus here versus here. Maybe 98% of fund managers are here, 2% here, and none here, okay? We don't know, okay? All we have is this distribution of fund managers. Here's what we see in the data, okay? We see a histogram, if you will, or a probability density function of the number of managers who have a certain alpha or a certain t-statistic of alpha at each point on this plot, okay? So we know that this is a mixture of these 3 distributions, okay, to the best of our knowledge, but we don't know, how many of each, what proportion of each. Does that make sense? So we have to infer a lot of stuff from the data. I think the main thing to take away from this figure is what is type, let's back up a second, what is the type 1 and type 2 error in this picture? And so this table is something that you should really get used to, okay? In type 1, so in statistical theory, type 1 error is rejecting the null erroneously, right? Falsely rejecting the null, right? And the null is usually no effect. So the null is something like testing a pharmaceutical drug on patients. The null would be no effect, right? It's usually how the null is set up. The null is kind of the no effect to a treatment, okay? In investments, the null can be that fund managers are 0 alpha fund managers. This can serve as our null hypothesis, okay? Makes a kind of a sensible null hypothesis that people should be willing to accept. If they randomly choose a fund manager, they should be able to get a fund manager who at least pays them for their fees and nothing else. Okay, so it seems to be a reasonable place to start. Okay, not everybody agrees with this. Some people think the null should be that managers are unskilled, but let's stick with the 0 alpha fund. So if 0 alpha funds are the null hypothesis, then we have to take a look at the alpha of a fund manager and make inference about whether that fund manager truly comes from this distribution or actually comes from this distribution or this distribution. So you can think of this as a 2-sided hypothesis test where here's the null, here's the alternative on the right, here's the alternative on the left. Does that make sense? Okay? I mean, this isn't just specific to funds, this is specific to any kind of 2-sided hypothesis test, this type of graphic or model. Okay? So how can we describe, so these are all t-statistics, and a t-statistic of about 1.65 means that you're in the right tail you're at the 5 percentile point, the 95 percentile point on the right tail. So in a one-sided 95% confidence test, if you observe a t-stat above 1.65, you conclude that this manager with 95% confidence is this, right? Or with 90, in a two-tailed test, it would be with 90% confidence because there's 5% here and there's 5% here. In a two-tailed test, you would say, I'm 90% confident that this t of 1.65 means that this manager is a skilled fund manager. Are you with me? Right? And a similar thing down here, if you observe a t, I don't observe these things here, this is a model. If I observe in the data from some kind of model a minus 1.65, then I say with 90% confidence I conclude that this manager is an unskilled fund manager. Okay? Now, you can see that if this manager truly is a skilled manager, then I've made a mistake, right? So there's always possibility. That's what statistical inference is all about, is about taking probabilistic inference, making probabilistic conclusions. There's no proof in the world, right? We look at data, we look at things in the world, and we try to infer, you know, as a scientist, infer the probability that something is right or wrong, okay? And with conservative inference, we generally stick with the null unless the evidence is overwhelmingly against the null, right? That's why we require 5%, 5%, and don't cut it deeper, right? Right? We're conservative, okay? So if I asked you, you know, where is the type 1 error in this plot, what would you say? Where is the type 1 error, the probability of the type 1 error designated in this plot, in this model? I'll give you a couple minutes if you want to chat about it. Where is the type 1 error? This is something I can very easily ask you on the final exam. I've done it before. Okay, so it's like a very fundamental thing. It's so easy. You got to get this. It's so easy. Where's the time point error? Figure it out. 2 minutes. Think. If you got the answer, raise your hand. Where is the total type 1 error in this diagram? One minute left. Okay, gang, time is up. So tell me where the type 1 error is on this diagram. Black area? Okay, why?
It's falsely identified because the manager is not E.
Because this guy truly is a 0 alpha fund, and I've concluded by his t-stat that he's a skilled fund manager. Anything else?
Between 0 and 0.5.
Here?
Yeah,
Why?
because it may be unskilled fund or skilled.
Well, you're talking about type 2 error, though. The type 1 error is falsely rejecting the null. So remember, if the null is your guideline, then the middle curve is what you're looking at. The 0 alpha fund bell curve is what you're looking at. okay? You don't pay any attention to the skilled or the unskilled bell curves if type 1 error is what you're after. We'll get to type 2 error in just 1 second. Type 1 error, anything else besides the black shade? How about the gray shade? How about the gray shade? That would also, in a two-tail hypothesis test, this would also be part of the part of the type 1 error, right? In a two-tailed hypothesis test, we reject here in favor of this alternative. We reject here in favor of this alternative. So the answer is both of those together are type 1 error in a two-tailed inference test, okay? Answer is both together. Add up to the probability of type 1 error. In other words, the size of the test. Okay? If this were a one-tailed test and I had no unskilled over here, then yes, this would be the only probability of type 1 error. Or if I had a one-tailed test where this was the only alternative, then yes, this would be all there was, okay? So we're just getting back to your basic statistical theory 101, reminding you of this. Okay, let's go to the type 2. And I kind of didn't really say it very well up here. Falsely identifying a skilled manager, saying he is skilled when he is really, and I should have said 0 alpha. I should have said falsely identifying a skilled or unskilled manager, saying he is skilled or unskilled when he is really 0 alpha. So forget my words there, they're all wrong. I need to rewrite that for my second edition of my book. Made a mistake there, okay? But you see what I'm saying, right? What the right answer is. Sorry? This again? So this is wrong. It should be falsely identifying a skilled manager or an unskilled manager, saying he is skilled or he is unskilled when he is truly 0 alpha. That's what it should say. I screwed up. I made a mistake. I get a C- on that page. Okay. Okay, type 2 error. What's type 2 error? Type 2 error is when you throw the baby out with the bathwater. Is one way to put it. You throw away something good. Okay? Because it didn't look so good in the sample. Okay? Type 2 error is, and let me redefine this the way I should have written it, falsely identifying an unskilled manager, falsely identifying a 0 alpha manager, saying he is 0 alpha when he is really skilled or unskilled. That's the proper words I should have said. Okay? Falsely identifying a 0 alpha manager, that's this guy. This is the null hypothesis. Falsely identifying a 0 alpha manager, saying he is 0 alpha when he is really skilled or he is unskilled, here or here, in a two-tailed test. It's the opposite, right? It's the opposite mistake, which basically can be very costly too, okay? Both types of error, type 1 error and type 2 error can be costly, but they're costly in different ways. With type 1 error, you invest in a manager that you should not have invested in, okay? With type 2 error, you did not invest in a manager you should have invested in. Two different types of error, two different types of penalty for this thing. You want to avoid both as much as possible. Where on the diagram would I be able to shade to find, it isn't explicitly on there, you'd have to shade it yourself. Where would the type 2 error be? Probability of the type 2 error on this diagram be? What would the probability of rejecting the alternative and accepting the null? Sorry?
Intersection between 0 alpha and unskilled skill between.
Right here. So what about that? All this area below that. That's right. No, sorry. Except here. Yeah. All this area over here. You get that? So this area, this weird diagram here, is the type, sorry, it's all the way, no, it's all the way up to here. It's all the way up to here. Right? Because here's the probability, it's all the way up to here. Here's the probability that the unskilled manager will get a t-statistic that is less than negative or greater than negative 1.6. So it's all of this area right here.
But the
Right here.
test said that it's
That's the
just
probability of,
zero alpha.
that's the probability, sorry?
The test said that it is the zero alpha, so maybe not above the zero alpha.
No. This is the assumed distribution of unskilled fund managers. All I want to know, forget about zero, we don't care how many zero alpha guys there are, but type 2 error, all we care about is this distribution and this distribution. Okay, we ignore the distribution of zero alpha, it doesn't matter. So the probability of getting a t-statistic between minus 1.65 and plus 1.65 under these two regimes. So it's this plus this. Okay, everybody see that? That's the type 2 error probability. Okay. Okay, let's move on. Listen, if you missed that, there's many words here that describe the type 1 and type 2 error. Let's jump right into some measures here. Okay, I talked about Sharpe ratio this morning quite at length. Where it comes from, it's basically the slope of the rate. It starts at the risk-free rate and goes through, remember I drew that this morning, starts at the risk-free rate and goes up to the manager's expected return standard deviation point. The slope of that is the Sharpe ratio. That's exactly what we've done here. This is the slope on the risk reward. You could call this a capital allocation line, but it's not really a capital allocation line because capital allocation line assumes this is the market portfolio. Okay? This is the allocation line available if you use that manager P. Okay? In actuality, we don't know what this actually is, so we have to estimate it through the average and through the standard deviation, estimated standard deviation. So here's the estimated Sharpe ratio. Okay, what is good about this Sharpe ratio? The good thing about the Sharpe ratio, well, the bad thing about the Sharpe ratio, first of all, is that the portfolio is assumed to be the entire portfolio. Okay? We already did number 2 this morning, so I don't really need to repeat that one. Okay? One bad thing about the Sharpe ratio, or one limiting assumption of the Sharpe ratio, is that it only assumes that the first and second moments are the only important points of the distribution of returns. We already did that this morning. Let's hit number 1. Okay? Let's see if I can illustrate number 1 for you. The easiest way I know how is to put side-by-side charts. One will be standard Markowitz theory. The second will be standard CAPM theory. Okay, the y-axis is the same on both, right? So what I can do is I can, first of all, mark. All I do is I'm going to make this, this will be excess return. So the risk-free asset will be at 0 here because this is excess return. This is RP minus RF, expected RP minus RF. So that means the excess return of the risk-free rate is 0. Okay, the beta is 0. Okay, so I can start at the same point. Okay, so everybody's familiar with this as the Markowitz diversification graph or the expected return standard deviation or expected return variability graph, whatever you want to call it. This is the expected return, this is the CAPM graph, expected return beta. Everybody's okay with that? The only difference is between the measurement of risk. Okay, I'm going to use this to point out one of the problems with the Sharpe ratio, because Sharpe ratio, as I said this morning, is based on this hyperbola. And what you want to do is, of course, you want to get a Sharpe ratio that's at least as good as the Sharpe ratio slope equals Sharpe Sharpe ratio of market portfolio, right? The slope of that is the Sharpe ratio of the market portfolio, right? Which is the expected return minus risk-free rate over sigma, right? Okay? Otherwise known as the capital allocation line, you guys were saying earlier today. Okay? Now suppose that I have a fund manager, so the idea here is that I have to have a fund manager who's out here in order to beat the market portfolio. Okay? I have to have a fund manager who's out here to beat that slope. I have to have a manager who gives me a bigger slope according to the Sharpe ratio, because that's what Sharpe ratio analysis is. Because I have to have a bigger reward to variability ratio to conclude that this manager is superior to that given to me by an index portfolio based on the market portfolio, right? Right? Okay? And it says that if I find a manager who's here, this manager is inferior. Okay? That's what Sharpe ratio analysis basically says. Inferior, superior. Okay? I could even label this guy as a superior active manager. So I could name him Sam, S-A-M, okay? And I could label this guy inferior active manager equals I am. I am a Sam, but I'm not really a Sam. Okay, if you want to like Dr. Seuss books, okay? My kids are well beyond that, so I'm not into that anymore, but it's still fun. Okay. Okay, so the Sharpe ratio says this is a Sam, but this is not a Sam. Okay? Let me throw you a little bit off balance now, okay, by showing a potential flaw in this reasoning. Okay, so let's first of all write so here is the security market line of the CAPM. Okay, I'm just going to assume for the purposes of this argument that the CAPM is okay, the CAPM is correct, okay? I don't buy that, but this is enough to just show that this Sharpe ratio is flawed even if the CAPM is correct, okay? Okay, suppose this superior active manager, now he's going to have to plot above the security market line, or there's no way that he's going to be able to get a Sharpe ratio better than the market. I don't disagree with that, okay? And he's actually got a beta that's higher than the market because he's elevated above it, I think, although I'm not sure. He could just have idiosyncratic stock picking skills that elevate this, I don't know. But let's say that this guy, is there any reason to believe that this guy couldn't be right here? Is there any reason, anybody give me a good reason why this guy could not be here, which is a more attractive alpha. This is alpha IM, supposedly IM, put them in quotes. This is alpha Sam, quotes. Is there any reason that IM couldn't have an alpha that looks like that? I hope you say no, because that's the right answer, okay? There's no, so how could a manager have a point here on the Markowitz diagram and a point here on the CAPM diagram? Does anybody have an answer for that? Again, a good CFA question. Harder one, but not terribly hard. How could a manager have a point here and simultaneously be here on this graph? Think of the notion of risk, because that's the only difference between these two graphs. One is total risk, one is systematic risk. Should be enough of a hint to give me an answer. You guys have an answer? You have an answer? Sorry?
On the CAPM diagram,
Yep.
first time should be one.
This guy? Why? these two metrics are different though. Anybody else give me a hint here of whether this diagram is okay? It could be okay. So I'll give you the hint. The diagram is okay. How is it okay though? How could it be okay? The back?
The risk of the non-risk model is measured by standard emission, but the risk of the pattern is measured by the systemic risk.
Right. Okay. So
So the plot on the area is not beyond the SFLR.
sorry. One more time.
The plot on the area
Yeah.
is not beyond.
Right. Right. I mean, either one is on the Secord-Meyer line. That's all right. Okay. Okay. But why could this guy have alpha here and a bad Sharpe ratio here? I mean, you almost have it. You almost have it. That means his sigma is high, but his beta is low, right? What does that mean? Sigma high, beta low, what does that mean? Come on, guys. Sigma high, total risk high, beta risk low. What does that mean? Idiosyncratic risk high, right? What does that mean? He's taking bets away from the market portfolio, right? Okay? Adjusting for beta, he's taking bets away from the market. He's holding big concentrated positions. Okay? This guy could be a very heavily concentrated manager, holding a handful of stocks, big total risk, big idiosyncratic risk, smaller beta risk. So this more properly indicates that this guy is a talented portfolio manager. This is flawed, okay? Because we should not penalize anybody for idiosyncratic risk unless it's the only portfolio we can hold, because we can diversify this guy with other people, right? That's the whole point of number one here. Okay, so number one can be answered with these two diagrams and with that example. Do I need to go over it again? Yes? Okay, so consider these two. Here's a way to show that number one must hold or the Sharpe ratio is flawed. Here's an example that shows that I have two managers. The Sharpe ratio looks better for this manager than for this manager, right? We get that, right? This manager has less total risk than this manager, correct? But this manager has higher beta risk than this manager, correct? As I show on this, because total risk is equal to beta risk plus idiosyncratic. This guy just has a lot of idiosyncratic risk. Once I put him on a systematic risk diagram, I realize that I should not penalize him for the idiosyncratic risk taking unless he's the only manager that I can hold, because this analysis is only good for your entire portfolio of wealth. This analysis is supposed to be good for every piece of every investment you make out there, right? By itself. That's why you use this when you do a capital budgeting problem or a corporate finance problem, is because beta captures the non-diversifiable part of that risk. Got it? Okay? Okay, so only if number one is true will the Sharpe ratio always be correct. If one is not true, Sharpe ratio could be incorrect or correct, who knows? Okay? And number three is also true, is that the Sharpe ratio analysis, along with this analysis too, it assumes that there's only one period of investment. If there are multiple periods of investment, remember that example I gave this morning, if the next time the president is elected, if I think the financial opportunities will be better, maybe I want to be conservative this period to preserve wealth for next period, and that's not captured in this one period model. And that's true both of Markowitz analysis and the CAPM, okay? But it definitely is a problem with Sharpe ratio at the very least, okay? Okay, let's, before we break, let's take a quick look at the Sharpe ratios of these guys. Okay, even though we know that's probably meaningless, okay? We just said there's so many problems with the Sharpe ratio. Let's take a look at what they are. So Peter Lynch earns a Sharpe ratio of 0.24 over his career. Bill Miller, 0.12. Scott Scholzel, 0.14. Of course, this one we wouldn't ever trust, right? Because this guy is a very concentrated portfolio manager carrying a ton of idiosyncratic risk, right? So I don't trust this at all. The only thing I find especially compelling in this table is how large Peter Lynch's Sharpe ratio is. It's pretty amazing, okay? And I don't think he held massive portfolios either. So this guy is just kind of an unbelievable portfolio manager, kind of one of those mythical figures, you know, that comes along once in a lifetime, I guess. Bill Gross, maybe the same can be said of him. He has a massive Sharpe ratio too, okay, over his period of time. So yeah, these guys are, you know, it's hard for me to explain how they did so well. But again, the Sharpe ratio is not a perfect, so the rest of the stuff is about kind of the technical features of Sharpe ratios. Let me go to one more thing here, because I want you to, it's okay, so we'll go to some regression-based performance measures, because we're going to come back and we're going to go in the FinLab and we're going to do some regressions, we're going to do some Sharpe ratios and stuff like that to finish off our Sunday. You know, I think most of you know what a single factor model looks like. This is just basically the time series version of the CAPM. This is RPT, the return on a portfolio manager minus risk-free rate, equals alpha, the intercept, plus beta, the slope, times RBT. Remember earlier I was saying this is RMRF, called it RMRF, okay? But the RM means market. It could be any benchmark, that's why I put RB here instead of RM, okay? So you could compute a Jensen measure, right? A Jensen measure is just the alpha from a CAPM regression, right? Right, okay? So I'm gonna want you to do that in the lab this afternoon. And, oh, and then the next thing is, maybe you can read this on your own. Read this benchmark choice point. This will help you to answer one of the questions early in Lab 1A, okay? So read this page here, and there's a footnote that goes with this too, footnote 14, and you'll be able to answer one of the problems in Lab 1A. Okay, any question about this material so far in Chapter 3? We'll stop here on Chapter 3. We'll pick up the rest of Chapter 3. I think you've got enough to answer number, I guess it's 5 through 8 or 4 through 8, whichever ones that I asked you to do to prepare for the quiz. I think you've got enough for that. So we'll stop here. We'll pick it up on Tuesday night, finishing Chapter 3. But what I'd like to do now is you can either proceed to the FinLab now, you can take a 10-minute break and get a glass of water, Coke or whatever, and then proceed into the FinLab. But we'll start up in about 10 minutes, okay? 10, 12 minutes. Let's say